Well, Finance 33, 20 students, it turns out that I'm a bit long-winded. So what happened just then when it cut off was that I hit the 1 hour mark, and I haven't done that before and didn't realize that I was limited to 1 hour. So live and learn. Let's go back through the problem that I was working on, and I think it cut off right in the middle. And that's this problem here, Ekins. Thomas Eakins was a famous artist, and he did some liked to do some paintings on the Schuylkill River in the Philadelphia area. I don't know if that has to do with him or not. Okay, so we're looking for the cost of new equity versus the cost of equity. That's what it says down here. By how much would the cost of new stock exceed the cost of common from retained earnings? So again, it's that the cost of, I'll call it new equity or New England, the cost of new equity is D1 over P0 times 1 minus the flotation percentage plus G. That's the cost of new equity. So let's figure that, and we've got 275 earnings and a payout ratio of 70%. So 2.75 times 0.70. And I'll go ahead and do the new equity version first. The flotation cost is 8%, so the price of 45 would be multiplied by 1 minus 0.08, and that's equal to 0.92. And then we're going to add G to that, and G is 0.06. Very easy to cross over between using percentages and using decimals, and obviously that is catastrophic when you're doing a problem like this. If you calculate this as a decimal and add this, calculate this as a percentage and then add this as a decimal, obviously it'll be wrong. So 2.75 times 0.7 equals 1.925. 45 times 0.92 equals 41.40, and add that to G. Oops, I'll go ahead and add that to 0.06. So 1.925 divided by 41.4 plus 0.06 equals 0.1065. Now if we were to just do the cost of equity, not the cost of new equity, but just cost of equity, it's D1 over P0 plus G. And we've got still 1.925, but instead of dividing by the price minus adjusted for flotation cost, we're just divide by the price. And obviously, since this numerator is bigger than this one, we're going to end up with a smaller number. Or put the other way, if you have to sell new common stock, it's going to have a higher cost than your retained earnings. Plus 0.06, so 1.925 divided by 45 plus 0.06 equals 0.1028. And then the question is, how much would the cost of new stock exceed the cost of common stock from retained earnings? So it's 0.1065 minus 0.1028, and that's equal to 0.0037 or 0.37 of a percent. And so that's this answer C. And actually nobody asked for this one, but there it is, so I think I'm going to go ahead and do it anyway. You're a consultant. This is a weighted average cost of capital problem, and consider that this is the type of problem, whether any of these. If you get to one where you just say that's a whole lot of calculations, and I'm going to go to the next one, because the longest, most difficult problem counts no more than the simplest, and you have to have some sort of test wiseness about you, and also know your own skills. So let's go ahead and solve this one. Their non-callable bonds mature in 20 years, have an 8% annual coupon, and I'm looking here and I don't see the word semi-annual anywhere, so we're going to assume an annual coupon. So let's go ahead and do the cost of debt. Let me see if I can put these about even. The cost of debt, and we'll do the cost of equity down here. And the cost of debt. Well, we need to calculate what the yield to maturity is. So, second clear TBM, second clear work. And we've got an 8% annual coupon. So I'm going to say 80 is my payment. A par value of 1,000. 1,000 is my future value. N is 20. 20 is my time frame, and my current price is 10.50. So 10.50, change signs, is my present value. So recall N is 20. Recall present value 10.50 negative. Recall payment 80 positive. Positive. Okay, so now I'm going to calculate the rate, and it equals 0.0751 really, and the tax rate is 40%. So I'm going to multiply that times 0.6, which is 1 minus 0.4. So times 0.6 equals 4. I'm going to do in decimals. 0.045055. I'm going to carry it on out like that. Cost of equity. Okay, we've got a risk-free rate, and we've got a beta, and we've got a market risk premium. So that tells us we're working on the capital asset pricing model. So that's equal to the risk-free plus return of the market minus the risk-free, and this is called the market risk premium, times the beta. So plugging in the numbers, we've got 0.045 plus, they don't give us RM, they do give us RF, but they give us the market risk premium of 5.5%. So market risk premium is this, so we're going to put 0.055 times the beta, which is 1.2, and when we multiply that stuff out, let's see, 0.055 times 1.2 plus 0.045 equals 0.111 equals, I'm going to put out here 0.1110. Okay, so that's our cost of equity. This is our after-tax cost of debt. Target capital structure. Okay, target capital structure. 0.35. So I'm going to multiply this by its weight. Its weighted average cost of capital. Its weight is 0.35. And this weight is the rest of it. It doesn't tell you 65%, but it says 35% debt, and the balance is common stock, so you have to calculate 0.65. So 0.1111, am I off the page? 0.1111 times 0.65 equals 0.072150, and 0.045, 0.0055 times 0.35 equals 0.0157, I guess. Yeah, close enough. 1, 2, 3, 4, 5. 1, 2, 3, 4, 5. Yeah. 15769, I'll say. 15769. So that'll be the same number of digits. Okay, so I'm going to add this number to this number. And that gives us 0.0879. That's adding these two guys together. And that would be answer, this answer here. I don't know, what's that? There seems to be a spot over this, and I don't know why that's there. Let's see. Sorry about that. This is my cursor. Okay, 0.0879, and that would be the weighted average cost of capital. Now, a student asked another question that has to do with, let's see if I can find that right away. Okay, so the idea here is, or the question has to do with how you calculate the after-tax cash flow from the sale of an asset at the end of a project. Well, we pretty much assume that you go through the project, you sell the thing at the end, it has zero book value, and whatever you sell it for, you have to pay tax on. That is, if the book value equals 0, then the after-tax cash flow from the sale of the asset is equal to the sale price, which I'll just call the market value, times 1 minus the tax rate. Now, all this means is it was worth 0 on the books. Book value was 0. So whatever you sell it for is, quote, profit, unquote. We don't call it that. We call it recapture of depreciation. But just think of it as you're selling something that didn't cost you anything. Well, it did cost you something. You bought it after all. But as far as the bookkeeping of it is concerned, it's worth 0 on the books. So when you sell it, you're selling it for total profit. So that's what you would have if the book value of the asset is 0. Now, what if the book value of the asset is greater than 0? Well, we can still think of the after-tax cash flow as equaling the market price, that's the amount that you sell it for, minus taxes. Not 1 minus the tax rate, but minus taxes. So, what would your taxes be? Well, your taxes would be the difference between the market and the book. If the book value is greater than 0, and I'm assuming the market value is greater than the book value, the market value minus the book value, and that's your, quote, profit, unquote, times the tax rate. I'll show that as a small t. I'm going to go ahead and put a bracket around this. So what is this saying? Your cash flow is the market price that you sell it for minus the tax you pay, and the tax you pay is the difference between what you sell it for and what it's on the books for. The text has this a little bit different than I do, and that's okay, but I like this version of it because I think it sort of structures it so that you see there's a price I get cash flow that I get when I sell it, and then I have to pay taxes. And the tax is based on the difference between what I sell it for and what it's on the books for. Multiply that by the tax rate, and that's my taxes. So that's how I would prefer to think of it in general. There was another question about weighted average cost of capital versus as it relates to NPV and IRR with regard to a project. So there's a passage in the text that says, well, we kind of use weighted average cost of capital and discount rate and interchangeably. But really what you should be using in evaluating a project is the rate that's appropriate for the money that's being raised for that project. And that means you have to consider the riskiness of the project. If the project is riskier than your company as a whole, if your company has a beta of 1.2 and the project is a 1.5, well then the required rate of return, the discount rate, the weighted average cost of capital, is going to be higher because in the case of using the capital asset pricing model, you'd be using a larger beta, and a larger beta with all things equal. Let's see, where's that? In this problem 104, if we had put a larger beta in here, well, obviously this number would have come out larger and the weighted average cost of capital would have come out larger. So you have to consider that riskiness when you're calculating the weighted average cost of capital that's appropriate for the project that you're looking at. Now, the question had to do with relating NPV and IRR. Well, NPV is that present value that you would get if you discount the cash flows at the appropriate discount rate. And the appropriate discount rate is the weighted average cost of capital that you calculate when you consider the riskiness of the project. So if you discount future cash flows at the weighted average cost of capital, which is the one that's appropriate for the riskiness of the project, if you discount those cash flows back to the present at that rate and you get 0 or a positive number, then it means that your project is earning at or above that required rate. If you have an NPV of 0, it means that actually you got exactly the rate that you thought you needed to get for the project of this riskiness. What about the IRR? Well, you're comparing the IRR to this required rate, and if your IRR is equal to or exceeds that rate, then you would consider it to be a good project. If it equals, the IRR equals the required rate of return, you would actually be at a point where NPV is equal to 0, because the IRR is that rate which would give you a 0 NPV when you discount all the future cash flows. So we're going to compare the IRR to the required rate of return, which would be the weighted average cost of capital if adjusted for risk. But if you use the weighted average cost of capital based on your current asset base, and this project is either higher or lower beta than your existing asset base, then you're really not using the right rate. So I think that's what the student was trying to get at. Again, as I know I've said this, I'm beating a dead horse on this, but the IRR is that rate which gives you a 0 NPV. IRR and NPV will give the same accept-reject decision unless the projects are mutually exclusive, if there's capital rationing, well, even if they're mutually exclusive. We would say, and the problem earlier sort of suggests this, that NPV is really the appropriate version to use, and the reason it's the appropriate version is there are a lot of reasons. One of them is scale. If you take a set of cash flows and then just add a couple of zeros to all the cash flows and the outflow, well, you'd get the exact same IRR, but you'd get a very different NPV. Well, we'd like the larger NPV. That is essentially trading an outflow now for future inflows that are worth more than the outflow. I think that's it. I don't know of any other problems that anybody requested, and so it's well past the time when I said they needed to be turned in. So I think I'm just going to have to leave it at that. My students historically have done better than average on the exam, and part of that has to do with time value of money, I think. Just consider that on this exam, even though it says time value of money is X%, don't forget that just calculating this right here, that was time value of money. And so don't underestimate how important the time value of money is on this. As you go through the exam, recognize that some problems are long and they count no more than the ones that are short. Don't allow yourself to get upset if you get into one of these long problems and you find out that your answer's not there. That happens. But with 50 questions and a 2-hour time frame, that's 2 minutes per question. Some aren't going to take nearly that long. Others will take longer, and that's just kind of the way it is. But the easy questions count just as much as the hard questions. When you go into an exam like this, just assume that there are going to be 10% of the questions that are stupid or trivial, or I don't remember that. He didn't talk about that in class. It wasn't in the book, whatever. That doesn't matter. You can't allow yourself to get sucked into that vortex. You have to keep your mind on your business. So don't allow yourself to get pulled aside mentally and stress yourself out more than you're already stressed out, because exams are stressful situations. Go with pace, but not so much that you start making a lot of mistakes. And don't forget to clear your calculator. I would just, you know how to do the problems. You can do them on your own. Whether you can do them under a timed exam is what we're going to find out. So good luck with it. I really want you to do well. I know this has been a challenging semester. I've done online courses before, but not last minute like this. I had time to prepare and make different types of videos. But I hope the videos have at least been helpful in lieu of actually being in the class. I've had some nice interactions with some students by email, and that was interesting. I'm going to be available over the weekend if you have sort of last-minute questions. Don't expect me to respond in 10 minutes, though, because I'm not going to be lingering over my computer waiting to get an email. But I will look during the day and to see if I have any questions. I won't be available on Monday, and Monday is the day of your exam. Good luck to you. I hope you feel like you learned something. I feel certain that you did learn quite a bit, and I hope it shows on the final exam. Good luck.